6.3 Cost, Price and Producer Surplus. Supply and marginal cost. Sellers distinguish between cost and price. Cost is what a seller must give up to produce the good, and price is what a seller receives when the good is sold. The marginal cost, the cost of producing one more unit of a good or service. The seller will produce one more unit of a good or service if the price for which it can be sold exceeds or equals its marginal cost. A supply curve is a marginal cost curve. For example, the supply curve pizza tells us the dollar worth of other goods and services that firms must forego to produce one more pizza. That is, the supply curve pizza shows the seller's cost, that is, opportunity cost, what he must give up. Figure shows supply, minimum supply price and the marginal cost. The supply curve shows in figure A the quantity supplied at given price when the price of the pizza is $10. The quantity supplied is 10,000 pizzas a day. In figure B, the supply curve shows the minimum price that producers must receive to supply a given quantity. To supply 10,000 pizzas a day, producers must be able to get at least $10 for the 10,000th pizza. It means that is the minimum supply price that the producer will accept on 10,000th pizza. Producer surplus. Producer surplus is the excess of the price of a good over the marginal cost of producing it summed over quantities produced. When the price exceeds marginal cost, the firm obtains a producer surplus. Producer surplus is the difference between the current market price and the full cost of production for the firm. So it can be calculated as the producer supply equals price the good minus opportunity cost of producing it. On the figure, producer surplus is always below price line, that is market price line, and above supply line or the marginal cost line. Figure illustrate the producer surplus for pizza tells us the quantity of pizza that producers plan to sell at each price and the marginal cost of pizza at each quantity produced. If the price of the pizza is $10, producer plan to sell 10,000 pizzas a day. The total revenue from pizza is 100,000 per day. That is price times quantity supplied. To calculate producer surplus, we must find the producer surplus on each pizza and add these surpluses together. In the figure, for the 10,000th pizza, the marginal cost equals $10 and producers receive $10. So the producer surplus on this pizza is 0. The supply curve shows the marginal cost of 5,000 pizza a day is $6. So producers receive a producer surplus of $4, that is $10 minus $6. The market price minus the cost, marginal cost on the 5,000th pizza. For the first pizza, marginal cost is $2. So on this pizza, the producer surplus is $10 minus $2, which is $8. The cost of producing pizza is the amount received from selling it, that is $10 times 10,000, which is 100,000 rectangle area in the figure, minus the producer surplus, which is $40,000, which is calculated by the area of the blue triangle, that is base times height times 2. That is, the base is the 10,000. Height is 8 over 2, which is 40,000, and is $60,000 is the total cost, that is the red area. The total cost of producing 10,000 pizzas a day is the red area beneath the marginal cost curve. The total cost equals total revenue minus producer surplus. So the total cost here is 60,000, that is the red triangle. Which is equals to total revenue, which is 100,000 rectangle area, minus the producer surplus, which is 40,000, that is the blue triangle. So the total revenue can be calculated by adding total cost plus producer surplus, which is the profit. Chapter review. Sellers distinguish between cost and price. The cost is what the seller must give up to produce the good. Price is what a seller receives when the good is sold. The cost of producing one more unit of a good or service is its marginal cost. The supply line is also the marginal cost of the firm, that is S is equal to MC. The producer's surplus is the excess of the price of a good over the marginal cost of producing it summed over the quantities produced. Producer surplus equals market price minus marginal cost of producing it. Producer surplus is the area of the blue line, that is base times height times over 2. Total revenue equals price times quantity sold. Total cost equals total revenue minus producer surplus, that is the red area.